Welcome to the fourth and final module of the Yield Curve Strategies reading. In this module we are going to investigate the last component of the return decomposition framework that's been introduced in fixed income at level 3, that being return to foreign currency. So there's a little bit of overlap here in our analysis with the currency management reading which is in the derivative section of level 3. In that reading we said that your domestic returns are driven by two returns. If you're investing overseas, your domestic returns are driven really by two components. That's the return in the foreign currency and the return due to changes in the foreign exchange rate. We are assuming here that you're unhedged. If you're in a domestic, if you're an investor and this is your domestic land here, when you invest overseas in a foreign land, essentially there's two sources of return. That foreign asset can go up and down in price. That would be a return in the foreign currency. And then as you bring that foreign currency back, there is the foreign exchange rate, which is moving up and down as well. Okay, so they're your two components of return. Now, I know foreign exchange, I know from experience that foreign exchange is an area that is not a great crowd pleaser with students. And the reason for that is that students don't have a system necessarily, or the ones that struggle don't have a system. Let me tell you my system. I've kind of started it here. Whenever foreign exchange rears its head, I always draw the investor, there they are, the stick person. I always draw them in their domestic land here, and I always draw the foreign land slightly below it here. And that reminds me that I need to have my quotes domestic over foreign. All right, I need to be looking at the number of domestic units there are per foreign unit. I need to have a direct quote to this investor. In order to use my equations, for example, if this RFX is just based on the percentage change in the exchange rate, then the rate that I need to look at is how many domestic units there are per foreign unit. All right, I need to have foreign fixed and domestic variable, because this quote is directly related to the fortunes of this investor. Okay, if the foreign currency strengthens, this quote goes up and the domestic investor wins, and vice versa. If the foreign currency weakens, this quote goes down, it buys less of the domestic currency, and this domestic investor loses. So this direct quote is not negotiable. I need it. And I always draw, you'll see me doing it, I always draw this out, the domestic investor. Here we've got an Australian portfolio manager, for example. So we've got an Australian here, and they're investing in a foreign land called the United States. So that's the foreign land here. And so I need my quote to be Aussie dollars per US dollars, per US dollar. Okay. Now you will remember at level 3 you are veterans of the CFA program, and you'll remember the slightly controversial way that the CFA Institute chooses to quote currency, that being they quote it as variable / fixed. I mean, I quite like it, but I'm used to it. They're quoting it as a fraction. In other words, they're quoting it as a fraction the way I'm looking at it. You know, number of the top one per unit of the bottom one. So, for example, here we need Aussie dollars per US dollar. All right, the number of Aussie dollars there are per US dollar, and I know that because the domesticity of the investor's domicile is Australia, and the foreign land is the US. Okay. All right. So all that setup was before any discussion about any investment, but that was just getting my head on the right way, getting my domestic head on. Look at that, you know, putting it on the top to deal with this problem, to deal with this situation. We've got a foreign US bond. It's trading. It's a 2-year zero. All right, and we're going to invest for a year. Okay, so we buy it at a price of 96.374. That's a dollar price, of course. Now we're told the US dollar per Aussie dollar exchange rate. We don't like that. We know we need Aussie per US. All right, so we don't like this. Boo. That's the wrong thing to be given. It's okay, we can fix it because we just flip this rate over. When it comes to the rates that we actually need, we're going to say our starting Aussie dollar per US dollar rate is 1 over 0.90, which is whatever it is, okay? For what it's worth, that's going to be slightly bigger than 1, isn't it? So it's 1.11, 1 on all the ones, okay? Or all the ones. My end foreign exchange rate is going to be the right way up, the way up that I need it. It's going to be 1 over 0.8. Now I can do that one in my head, I think. I think that's 1.25. Let's just check. 1.25. Yeah, okay. Great. Now, this quote is moving in the same direction as the investor's fortunes. That's the whole point of arranging it like this. So we can see that we've won from the currency. That foreign US dollar is buying more of our, if we get in the shoes of the investor, our Australian dollars. All right. And by the way, the US bond ends the year at a dollar price of 99.939. So calculate the unhedged foreign bond, calculate domestic Aussie dollar return for this foreign US dollar bond. What you can do is just now you've got your exchange rates around the right way, you can just calculate the foreign currency return by looking at the US dollar prices. You can calculate the foreign exchange return by looking at the change in this foreign exchange rate, compound them together and subtract the 1 and you are done. So yeah, I mean there's gaps on the slide here, but the foreign bond local return is just going to be its dollar price at the end, which was 99.939, divided by the dollar price at the start, which is 96.374, minus 1. Okay. In fact, actually, do you know what? 1 plus, the easy way to think about it is 1 plus the return in the foreign currency is just the end price of 99.939 divided by the start price of 96.374. That's the return in the foreign currency. 1 plus the foreign exchange return is ending exchange rate, which we said was 1.25 when we put it the right way up, divided by 1.11. Okay. Obviously, you'd subtract ones here if you wanted to get to the actual returns, but why do we subtract ones and then add them back again? Why don't we just say, look, our domestic return is 1 plus the foreign currency return, which is, you know, whatever this is, 99.939 divided by 96.374. We've made more dollars, all right, to the tune of, I'll call that 1.037. We're 3.7% better off in terms of US dollars, right? In terms of the number of Aussie dollars there are per US dollar, we're better off as well. In fact, that's huge. We've grown by a factor of 126 there, 1.126 or 12.6%. So when I compound them together, I get 1.037 times 1.126. Maybe, I'm looking at this, I'm thinking my rounding's a bit aggressive here. Let's go with 1.2500 and 1.1111. Let's try that. I'm looking at this and thinking maybe I've rounded it. I've been a bit too keen with my rounding. Yeah. I'm going to change this to 1.125 because when I complete these decimal places, I kind of knock the zeros off because they're insignificant, and then I knock these off and they're not insignificant. So we'll just adjust this. It's 1.25 divided by 1.1111. All right, yeah, okay, that's better. All right, and that knocks that decimal place down just a touch. Okay, but compound them together. So 1.037 times 1.125, subtract the 1 that you started with, and you're looking at a whopping gain of 16.7%. Now that is an unhedged return. Probably the most important thing there, although we did do it in fixed in the currency management reading, the most important thing there is getting your rates around the right way. Here's the solution agreeing with our analysis. In fact, there's the solution over 2 slides agreeing with our analysis. Okay. All right. Now the hedging decision. There's a lot of overlap here with the currency reading, isn't there? The hedging decision. Let's say we've got an Australian portfolio manager still, all right, and they're holding the US bond for 2 years to maturity when it redeems at par. That would be, of course, $100. All right. The original price remains the same, and the original US dollar Aussie exchange rate. Now, just to go through the process again, we've done it already, but you put your domestic investor in their domestic land, and then you say they're investing overseas, and you put the foreign land lower, and then that physically on the page shows you that you need Aussie dollar over US dollar. All right, that's the rate that you need, the number of Aussie per US, and that's not the right way round. That's the number of dollar per Aussie. So once again, we flip it over. The starting rate that we need, Aussie over US, is 1 over 0.8 here, which is 1.25. That's what it moved to before, wasn't it? All right, so just be careful with that. The starting rate is now 0.8, so we're now starting with a rate of 1.25. Not massively helpful, but we can deal with it. It's okay. Now look, an equivalent 2-year zero coupon Aussie government bond was yielding 5% at initiation of the trade. You might have had to have, it might have been necessary for you to have backed that out of the implied return from a 2-year Aussie zero. For example, you might have been told that a 2-year Aussie zero was trading today at 90.703, something like that, and you might have been therefore expected to realise that if that's going to grow into 100 over 2 years, then the annual return here, or the domestic interest rate that you're going to assume for the Aussie market, it's going to be end divided by start. That's 1 plus your 2-year return. So you're going to annualize it by putting it to the power of 1 over 2. In other words, square rooting it, right, and subtracting 1. So you might have had to do that. 100 divide 90.703 equals, then just square root it, right, subtract 1, and it's the 5% we started with. I'm just showing you that extra moving part just in case it isn't given to you on a plate in quite such a user-friendly way. Now, calculate the fair 2-year forward rate. Oh, okay. So this is the exchange rate that we can essentially, as an Australian, we'll be thinking about selling our US dollars forward to remove currency risk. And then using the fair forward rate, demonstrate that the manager would earn their domestic risk-free rate if they hedged their position. In other words, demonstrate that they would earn 5% if they invested in a hedged foreign US dollar position. Now, the fair 2-year forward rate, how do we get that? Good time to revise, actually. How do we get fair forward rates? We get fair forward rates through the equilibrium, the no arbitrage equilibrium parity relationship, which is covered interest rate parity. Covered interest rate parity, which is a no arbitrage rule for derivatives, in other words, forward rates, states that in order that essentially we don't earn an excess return by depositing in high interest rate currencies and then selling it forward, because that's not risky, is it, if you sell it forward. In order that we don't earn extra return there, if we take a hedged foreign currency position, we need high interest rate currencies to be weaker in the forward market. That's what it says in words. Covered interest rate parity says that high interest rate currencies should, if markets are efficient, trade at a forward discount. And if they do, you don't earn excess return on a hedged foreign currency position, which is really what we're demonstrating here. Now, you might remember there's a neat little formula here, which is, if you go with this kind of variable over fixed quotation, CFA will always give you variable currency per units of fixed currency. All right, that's what they'll give you. But I always think of it as the fraction that it is. I kind of like stand it up like that. It's the same thing. All right, this divided by this. It's the same way of quoting it, but I stand it up to make it more obvious. And I like standing up like this because it reminds me that my parity relations are pretty neat as well. They can be stood up like this. Your forward rate is your spot rate. So your forward rate for delivery time T is your spot rate, just multiplied through by interest rate differentials. So multiplied through by 1 plus the variable interest rate divided by 1 plus the fixed interest rate, okay, to the power of T, number of years. That's your covered interest rate parity formula. This formula ensures that high interest rate currencies trade at a forward discount. They're weaker in the forward market. All right. For example, if RVAR, your variable interest rate's higher than your fixed currency interest rate, then obviously your forward rate's going to be higher than your spot rate, because this is going to be greater than 1. This second term here is going to be greater than 1. Now, what does that mean, the forward rate being higher? Forward rate being higher, don't forget, if the quote goes up, it's the base currency, the fixed currency that's strengthening. All right, so if the quote's forward rate is higher when our VAR is bigger, it's actually this currency that's strengthening because it's buying more of the variable currency, and it's the low interest rate currency. Great. So the relation does work. All you need to do is to be very clear at the outset which one's variable, which one's fixed, and then apply the variable over fixed mantra when you're adjusting spot by interest rate differentials to get to forward rates. And that's what we're going to do. We're told, in this particular case, we know that we want Aussie variable and foreign fixed, right? US dollar fixed, okay? We're told that the Australian government bond was yielding 5%. Now that is your domestic and variable risk-free rate. So that's your RVAR in this case. All right, if we've got our quotes around the right way, which we have, then that's your variable interest rate. Now, to get our foreign interest rate, we've got to think about this US dollar bond going from 96,374 up to 100 over 2 years. Well, yeah, I jumped the gun here, didn't I? I said you might have to do that. Well, look, that's what we did with the, it's what I surmised you may have to do with the Aussie to get that 5%. We are actually going to have to do it here to get the US dollar essentially risk-free rate. And the way that we do it is we say the US dollar risk-free rate is an ending value of 100 divided by a starting value of 96.374. That gives you 1 plus your 2-year return. You can take the square root of that because there's 2 periods here. It's the power of a half. Subtract 1 and you're done. So what do we get there? 100 divide 96.374 equals square root minus 1. That's 0.0186, so I'll call that 1.864%. Okay, so now that, I'm just going to give myself a bit of room here so we can see what we're doing. That 1.864% there that I've just calculated, that is the US risk-free rate. In our terms, that's the fixed risk-free rate. Okay, so when we think about our ingredients now, we've got 2 years in play here. All right, so that's our maturity, and we're pretty much there now for part 1, aren't we? We can just use our covered interest rate parity formula, take the current spot rate the right way up. What was that? That was 125. And then multiply through by 1 plus our VAR, which, don't forget, because we're an Australian investor in the US, we needed domestic Australian dollars variable and the foreign currency fixed. And so on the top there, we've got the Aussie rate, so that's 5%. We've labelled that already. So 1.05. And on the bottom, we've got the foreign risk-free rate, which we just calculated it to be 1.864% from those prices. And don't forget that's for 2 years. So my fair forward rate is 1.25. And what you can do, by the way, actually get rid of all this junk here. So do 1.05 divide 1.01864. Hit equals, square it all, right, and then multiply by 1.25. That's the neat way to do it. And we get 1.328. That's your fair forward rate, number of Aussie dollars per US dollar in the 2-year forward market. Okay, so going back to the slides here, we're reassured to see they come to a similar conclusion as to our analysis. So Moving on to the second part of the question, demonstrate that the manager would earn their domestic risk-free rate if they hedged their position. Of course, we've got an Aussie investor here, and the Aussie risk-free rate is 5%. And this is the whole idea with covered interest rate parity. Covered interest rate parity says that high interest rate currencies should be at a forward discount. The whole idea is if they're at a forward discount, then when you sell these high interest rate currencies forward, the discount on the forward exchange rate offsets any interest rate differential, meaning that all investors get their domestic returns, which is only fair on a hedged foreign currency deposit because you're not taking any extra risk. So let's take a big picture approach and tread carefully here. It's very, very easy to trip over with foreign currency. We've got 2 periods. In terms of US dollars, we're buying a bond for 96.374 today, and we know it's going to redeem at 100 in 2 periods' time. These $100, these 100 US dollars, these are what we're going to sell forward at a forward rate of Aussie over US dollars, 1.328 Aussie per US dollar. So we multiply through by that to go from base to price currency. In other words, we multiply by 1.328 to say we're going to end up with 132.8 Aussie. The amount of Aussie that we start with, now you might remember, seems like a long time ago now, but at the start of this particular question, they gave us an original exchange rate of US dollars per Aussie dollars of 0.8. Now I flip that over because I don't like foreign over domestic in this analysis, and you shouldn't like it either really, because we do need to see domestic over foreign. All right. Now I know that might not be the shortest route here, but trust me, over the course of your studies, flipping the exchange rate over like this to get your domestic head on the top is the benefits are going to far outweigh the costs of not doing that. What this means, of course, when we're thinking about a US dollar amount that we've got, and we want to think what that's worth in Aussie, we multiply through again once we've got this quote that way up. So we can multiply through by 1.25. 1.25, that's a 5, okay, and we should get the same number as this, 120.4675, all right, looks about right, doesn't it? And yes, it is. So the slides here have not bothered to flip the rate over. I mean, that's okay, but they just need to appreciate that when they're thinking about how much these dollars are worth in these US dollars are worth in Australian dollars, they're going to need to divide down because they're going that way, right? So that's why they divide down by 0.8. So remember, you divide down, you multiply up. If their quotes ran the other way, then they're going to have to do the other operation. They're going to have to divide down. Anyhow, all right, if you go from 120.4675 Aussie dollars to 132.8 Aussie dollars, your periodic rate of return is end divided by start. That will be 1 plus your 2 period return, and put it to the root, the second root, in other words, the square root. That will get you to 1 plus your average return. Take the 1 off, and you're staring at your periodic return, which of course is the number we first thought of. This formula, it's this formula here that makes sure that the high interest rate currency trades at a forward discount. Which is set by interest rate differential. So really we're just checking that we've correctly used we got the correct result when we use that formula. Okay, so the analysis so far has been relatively simplistic in so much as we've been dealing with zero coupon bonds. Let's complicate things a little bit by thinking about hedging a foreign coupon paying bond. All right, now we know a coupon paying bond has got regular coupons coming in and then a par payment back at the end. The instrument that we're going to use to hedge regular coupons coming in is a cross-currency swap, where we exchange principal at the start and the end of the swap. Okay, remember with cross-currency swaps, we're going to assume we've got fixed legs, okay, and you do exchange principals at the start and the end of the swap. Now, if you focus on, once again, if you focus on the big picture, Are we sticking with the Aussie manager? Yeah, we're sticking with the Aussie manager. If you focus on the big picture, right, the Aussie manager, I always draw the manager as a stick person, has got US dollar exposure. And in this case, I'm going to focus on the coupon. We're getting a US dollar fixed coupon coming in. If you just focus on, when it comes to the swap, getting rid of that foreign fixed income, in other words, pay away the fixed foreign income. So pay away US dollar fixed under the swap. Here's the swap dealer here. Hello, swap dealer. Pay away what you don't want, which is, there's the bond. Paying its fixed coupon. You don't want that, so you pay away US dollar fixed and you receive in return Australian dollar fixed. Okay, Aussie fixed. And so that tells you what you need to do. If you just focus on the coupon, that tells you what you need to do. Pay away that regular US dollar coupon that's coming in. That regular fixed US dollar coupon that's coming in. Now, the thing about this cross-currency swap is that you do need to exchange principals at the start and the end of the swap's life. Now, the way to think about which way the principal goes is to think, look, the reason why this investor is making US dollar payments out is because they've effectively, they actually have, at the start, received US dollar principal in, all right? So they've borrowed US dollars in at the start. By the way, they can use those US dollars in to pay for the bond. All right. This is at the start. Also at the start, by the way, the Aussie investor will have to deliver out Aussie principal, and that's why they get paid an Aussie fixed rate in, because essentially it's this party here, the swap dealer, is essentially borrowing Aussie dollars from them and paying a cost of funds back. All right. Now, at the end of the swap's life, I know it's going to get quite crowded here, but at the end of the swap's life, we just return these principal amounts. Okay? At the end of the swap's life, we're going to have to pay back the US dollar principal. That's going to have to go back. All right? And we'll receive back our Aussie principal. Okay? But that's at the end. The red lines are at the end. And interestingly, of course, at the end of the bond's life, you sell the bond, and in comes the US dollar par amount, essentially, at the end. The red lines are at the end, and that's what can be used to pay back the Aussie dollar, the US dollar principal, all right, in return for the Aussie principal. Now, look, I know there's a lot of lines there, but if you focus on the coupon, this does simplify quite a lot. Let's go with our Australian manager. They're hedging a US foreign 100 million par of a 10-year US Treasury bond, currently trading at par. Current US Aussie exchange rate is 0.8. So they've done that again. US dollar over Aussie is 0.8. If I thought I was going to use that extensively, I'd flip it over to 1.25, but I don't think we're going to use it extensively here. You know that I prefer to see domestic over foreign, and you should prefer that too, because that's really that's directly in line with the Aussie investors' fortunes. If it goes up, the Aussie investor's winning. If it goes down, the Aussie investor is losing. And when I say Aussie investor, I mean the Aussie investor that's invested in US dollars, of course, invested overseas. Right, the manager enters a fixed for fixed cross-currency swap to pay. Okay, just focus on the coupon. We've got under the bond, whatever's coming in, we've got US coming in, we want to pay that away. So we're going to pay away fixed US dollars, and receive fixed Aussie. That's the coupon. All right. Now, if you're paying away US dollars, that's essentially, you can view that as a cost of funding the US dollar position under the swap. So you're going to use a US dollar size under the swap of 100 million. That's going to come in at the start. And that implies, if we go from US dollars to Aussie dollars, we can multiply by 1.25 to get this 125 million Aussie dollar size for the notional principal of the other side of the swap. So, in summary, this does simplify quite a lot. There's your bond, all right? At initiation, you need to pay for it. You receive fixed US along the way, and at the end, you get your US dollars back. This fixed for fixed currency swap, the important thing, as I keep saying, is that you pay away whatever you're receiving in under the bond. So get rid of that US dollars, those US dollars that are coming in. That means you'll get fixed Aussie coming in, okay? Notice that what you need to pay, the foreign currency you need to use to pay for the bond comes in under the swap and washes out what you need to pay under the bond. So they wash, and you're just left essentially paying out the Aussie principal at the start. Similarly, the principal you get back on the bond washes out with the principal you need to pay away under the swap, and you're just left with receiving the Aussie principal at the end of the swap's life. Of course, the net result here, I could cross out the yellow stuff because then they net out. The green stuff is what's left. And the green stuff is paying out 125 Aussie today, receiving a fixed income in Aussie, and receiving 125 Aussie at the end of the investment. And of course, yeah, the slides say, look again, you know what we've done here. We've synthesized a domestic Aussie dollar bond, all right? And the manager's hedged all foreign currency exposure, essentially. Really what's happened, if I were to take this approach, what we realize is what we need to purchase the bond with, that's dollars, has come in under the swap. What we get under the US bond has been paid away under the swap, all right? And what we're left with, by the way, the dollars we get back at the end from the bond, we need to use to pay back US dollars at the end, US dollars at the end. So what have we got? Aussie principal out today, green, Aussie principal back in at the end, red, and an Aussie fixed rate coming in, okay? Right, okay, now we're going to revisit an old friend now. We're going to revisit the carry trade. So the carry trade, by this stage, this might be the last time we ever look at it. I think there's a good chance it would be. And we should know what it is, right? The carry trade is a trade where you borrow in a low interest rate currency and you deposit in a high interest rate currency, all right? Now, there is a theory out there. We've just looked at covered interest rate parity, which sets the forward rate. That should hold in efficient markets. There is another theory called uncovered interest rate parity. It's not the same thing. It looks very similar, but it's not the same thing, and woe betide, serious woe to anybody that muddles these parity relations up. Uncovered interest rate parity is very similar, but it's not the same thing. It says that high interest rate currencies weaken. Now just take a moment to appreciate the difference between uncovered interest rate parity and covered interest rate parity. All right, there's covered interest rate parity. High interest rate currencies should and do in an efficient market trade at forward discount. So that sets the forward market price, sets a derivatives price. Okay, that's not what's happening here. What's happening here is we've got a forecasting tool. We are forecasting that high interest rate currencies will weaken. Now, I know a lot of you will be sitting or standing, depending on what you're doing, there and thinking, that's not true. High interest rate currencies, if anything, they strengthen. And yeah, you're right. This tends not to hold. And so we can exploit it not holding. If high interest rate currencies don't actually weaken, we can hold an unhedged position in a high interest rate currency. It doesn't actually weaken according to interest rate parity, and therefore we can make a gain. And that means the carry trade can work. All right. So the carry trade working implies uncovered interest rate parity does not hold. It implies the high interest rate currency does not depreciate by the interest rate differential, by its interest rate advantage. Of course, the risk is that it does. High interest rate currencies, we're talking here about riskier currencies, currencies that people load up on when they're comfortable taking risk. Most of the time they won't suddenly collapse, but sometimes they do. So this carry trade, you've got to be careful, because when there's a rush for the exit in high yielding currencies, emerging market currencies in particular, if you don't get out before the crush happens, it's going to hurt, and you can suffer significant losses. All right. Of course, all of this stuff has been covered elsewhere, and it is covered in the currency reading too. But let's have a look at an example of the carry trade. A manager is considering executing a carry trade with a 1-year time horizon, that's your investment horizon, borrowing US dollars, they must be low interest rate, and investing in short-term Indian rupee securities. So short-term securities offering rupee risk-free rates, or relatively risk-free rates. The manager will borrow at 1-year US dollar rates of 1%. There you go, there's the low funding currency rate. And they will roll 90-day Indian securities. So these must be money market securities, which currently offer a rate of 5%. That's the high interest rate on an annualized basis. The current Indian versus US dollar spot rate, so Indian rupee per US dollar spot rate is 70. Now with this one, we want to view the exchange rate in terms of the currency that we deposit in, because if that currency strengthens, we win because we're holding it. If that currency weakens, we lose. So on that basis, we want, with the carry trade, we want to view the exchange rate in this way. We want the deposit currency on the base. In other words, here, because we're depositing in rupee, we want to think about how many dollars there are per Indian rupee. Okay? Why is that? Well, because we are holding rupee. All right, our fortunes are in line with rupee. If this quote goes up, it's telling us how much the rupee is strengthened in terms of dollars, and we are winning. If this quote goes down, it's telling us how much the Indian rupee has weakened. We're holding it, and we are suffering. Okay, so this quote is the right way round for our carry trade. It's where the deposit currency is on the base. Okay, and so once again, we're not having much luck with these quotes, are we? That's the wrong way round as far as we're concerned. I'm going to have to view this as an opening exchange rate. When I think about how many dollars there are per rupee, I'm going to think there's 1/70, which is not many. That's going to be a small number. Not so small. We've seen smaller. So I'll go with 0.014286, just so I've got enough decimal places for comfort. It says here, number 1, calculate the return from the carry trade if interest rates and exchange rates are stable. Now, carry traders love stable conditions, because with stable conditions, it means the high interest rate currency hasn't depreciated, exchange rates have stayed where they are, and we're going to collect the interest rate differential. So happy days there. Part 2 here, calculate the return if the 90-day interest rate moves around. Obviously, we want the interest rate that we're depositing in to go up because we're earning it. It does fall a bit here, but that's not great. That's eating into our interest rate advantage. It's still above what we're funding at, the US dollar, and you're told the final INR rate is 85. So that's pretty loose language. They must be talking in the same language as this, Indian rupee per US dollar. Now, if the Indian rupee per US dollar has moved to 85, if this thing's gone up, it's the base currency that's strengthening. That's bad news. Don't forget, we have to invert this. We care about how many dollars there are per rupee, which we're holding, and that is 1/85, and that is lower. That's a lower number. So we are suffering on the exchange rate here. The rupee that we're holding are buying fewer dollars, less dollars, and to be exact, they're only buying 0.011765 at the end of our period. Okay. So we're being asked here, number 1's easy, I think. Calculate the return from the carry trade if interest rates and exchange rates are stable. It's easy, I think. It's easier. You just got to be careful with the way that the interest rates are quoted for these, what are presumably money market 90-day securities. You're quoted that they are 5% and it stays stable, but don't forget that's an annualized quote for 90 days. And, a money market quote would be quoted on a day count convention. So this 5% annualized quote is not a true compounded return. It's just your 90-day return multiplied by 4 essentially to scale up from 90 to 360. We'll assume it's approximately 4. Okay? So what you need to do to actually compound this rate every quarter, for every quarter throughout the year, is divide it by 4, because that's the periodic rate that you get. Decimalize it, divide it by 4, add the 1, and then power up by 4 to compound it properly. Okay, so 0.05 divided by 4 plus 1, power up by 4. All right. So yes, you need to subtract the 1 as well. So there's a minus 1 missing there. So you subtract the 1. Okay, and you end up looking at 0. So subtract the 1, 0.0509, and we round that to 5.1%. So that's what you're earning on your rupee deposit. Okay, your cost of funds is 1%, and with no change in exchange rates, we could say, oh, you buy the rupee and then you exchange them back. But if there's no return due to foreign exchange, then the only return is due to differences in interest rates, and so you collect the interest rate differential. Your return is 4.1%. Slightly more going on with the second part, where the deposit rate, the rupee rate, evolves to be different for each 90 days, as you'd expect it, and the final rupee rate is 85, which, as we know, we need to flip over, think about how many dollars there are per rupee. So we flip it over, and that's how we got that number earlier. Where is it? It's a small number, but 0.011765. Okay, I won't write it again because it's here, isn't it? It's here. 0.011765. That's the inverse of 85. That's what we end up with. You might remember that the exchange rate that we started with was 70. That was rupee per dollars. 70, and when we flip that over, that's how we get the end exchange rate the right way round. So yeah, we've got all of our sources of return here. We're focusing on the FX for now, so we might as well stick with that. With an ending dollar per deposit currency, whatever we're depositing in needs to go on the base, as we've said. We've got an ending exchange rate of 0.011765. We've got a starting exchange rate of 1 over 70, which is this 0.014. So end divided by start is 1 plus your return. Take off the 1, and you're looking at a return. And as we suggested, the fact that the correctly, the correct quote with the deposit currency on the base has fallen means we're losing on the foreign exchange. We're losing a lot. We're losing 17.6%. On the deposit, each one of these rates, we can take it divided by 4 and then compound it with the other rates. Yeah, we're only earning it for a quarter. So once again, we're de-annualizing the annual rates for a quarter, and we add the 1 and compound and multiply together. Subtract the 1 at the end, and you're looking at an interest rate return of 4.6%. Yeah, all that discussion about inverting quotes is summarized neatly there, isn't it? Okay, so what is this telling us? Well, this is coming in on our deposit. This is a loss on the foreign exchange. Don't forget, we also need to fund our US dollar position as well. So in comes the high deposit interest rate. There's the FX loss of 17.6%, and we also need to fund the US dollar position. We've borrowed in US dollars, which cost us 1%. So we've lost a total here of 14%, which is, a good example of how when, the high interest rate currency weakens, you can lose a lot of money. All right. Okay. Now on to a really nice opportunity to revisit that 5-step return decomposition framework. This is, I think, maybe the 4th time we've come back to this, and we even come back, well, say the 4th time, maybe it's the 3rd time, but I think we come back to it again in the credit reading. I know we do. So this is all over the place. I can't emphasize how important this is. We should be comfortable about the 5 stages here. All right. And the stage that we're going to look at here, actually we're going to realize, or we're going to apply the first 4 stages to a foreign currency asset and then we're going to be a little bit more sophisticated about how we calculate the currency gain or loss in the fifth step. Okay, let's have a look at an example. Now, we have seen all this before. That's the reason I'm not going through it step by step. We have seen all this before, and it's been all been explained on a couple of occasions. We are assuming this model is for a year. That's why we're taking the annual coupon and thinking about its size relative to the price today. That gives us our coupon income. And don't forget, 1 and 2 is referred to as rolling yield, not to be confused with the roll down return. Don't forget that the roll down return number 2, step 2, assumes a static curve. All right. In other words, no shift up or down, no delta y. Okay. Delta y comes in parts 3 and 4 due to either the benchmark rate shifting or spread shifting. Okay. Now let's have a look at an example that mimics what goes on in the curriculum. Really, these examples are informing us what we need to do should it be tested in the exam. So here we've got a US dollar based portfolio manager. Okay, considering investing in Canadian zero coupon bonds. Now, you know by now that just my comfort blanket here to stop myself, to make sure I've got my head on the right way, I draw the investor in their domicile. This time it's a US dollar investor. And then I draw the overseas foreign land, Canada down here. And then that, it physically shows me I need to look at the number of US dollars per Canadian dollar. And that's what I'm interested in. Okay. I'm not sure it's such a big deal here actually, because look at this expected change in Canadian versus US. They're just telling us here that the Canadian dollar is expected to weaken by 0.5% versus the US dollar. So look, it doesn't do any harm for me to go through this that kind of good hygiene, if you like, because you will need it, but in this particular case it wasn't required. The expected 1-year performance data is shown below, so average bond price, and we're comparing a bullet where cash flows are intermediate in the middle, with a barbell where cash flows are spread out in long dated and short dated maturities. And the major difference between these two portfolios, if they have a similar duration, which they do, the major difference in terms of their risk is going to be convexity. The barbell with its more dispersed cash flows is going to have a higher convexity, as we can see there. We've got an expected shift in yields here, delta y, so the curve isn't staying stable. And we've got an average bond price today slightly different, a 1-year price assuming a stable curve, so that's without the curve shifting, is slightly different as well. Okay, so the challenge here is to calculate the components of expected return from the bullet and barbell over the next year. In other words, apply the total return decomposition formula and then discuss reasons for the difference. I've really alluded to one of them by referencing the differences in convexity. And I've alluded to another one by referencing to differences in roll down prices. So let's start with the coupon income, step 1. Both portfolios only contain zero coupon bonds. Maybe we didn't emphasize that enough to begin with, but both of these are containing only zero coupon bonds. So there's no coupon coming in along the way. That's a simplifying, situation. That makes things nice and easy. Step 2, roll down return. Okay, now that's actually relatively easy as well, because we just take these prices that we're going to roll down to, okay, compare them to the prices that we started with. So divide end by start and subtract the 1, and we end up with a roll down return. A slightly higher roll down return for the bullet. All right, 2.067% versus 2.01% for the barbell. Okay. Now, step 3, we are assuming that there is a change in yield, a shift, all right, and the shift is, you might remember, 25 basis points positive. That's going to have a negative impact on prices. So delta y is 0.25% divided by 100 to decimalize it, which of course is 0.0025, and that's what goes in to our duration and convexity adjustment formula. Here's the modified duration of the bullet. Here's the modified duration of the barbell. Here, and then it's with the convexity adjustment, you're adding a half of the convexity. Okay, there's the relative convexities. You can look back at that original slide and check that those numbers tally up, which they do. Okay, now if you work in decimals, decimals in, decimals out, you should be getting minus 0.012114 here for the bullet, and minus 0.01217. They're being expressed as percentages here, but the mantra decimals in, decimals out. It's not just a nice thing to chant here; it's a necessary thing to do. Otherwise, you are going to get it wrong. Okay. The impact of changes in yield spread. Yeah. Okay. What have we been given here? We've been told that bond yields are changing. We've captured the full bond yield change in step 3. They haven't mentioned spreads. So, maybe spreads changing and benchmark rates changing are all wrapped up in this 25 bips. Or maybe spreads just aren't changing. The bottom line is we've done all of our delta Y adjustment. Delta Y is changing benchmark rates and changing spread. We've done all of that in this adjustment here. So there's no mention of spread. So there's nothing we can do with it. We assume the spread change is 0. So now we come to step 5, the impact of currency. Steps 1 to 3 that we've just done, when we bolt them together, you might remember there was for the bullet, there was a roll down return of 2.067 and what we just calculated to be a duration and convexity impact of the yield curve shift up of minus 1.214%. Okay, those two numbers come from before. You can bolt them together. Technically it's part 2 and part 3. Bolt them together and you get 0.853%. For the barbell, part 2, the roll down return was 2.010 and the impact of the shift in yields was 1.217. And there you go. There's that's the return on the barbell. That actually is your return in the foreign currency. So what have we got here? We've got an American investing overseas in Canada. So really that's the return in Canadian dollars. All right, you've actually calculated the RFC here, the return in the foreign currency. When we think about bolting on the impact of foreign exchange, what we've been told is that the Canadian dollar is expected to weaken versus the US dollar, so we're losing 0.5% there. You can compound that 0.5%. All right, 0.5%, of course, is in basis points. In decimalized terms, you divide by 100 to get this negative 0.0050. All right, and when you add 1 to that, you're essentially subtracting this from 1. So you're compounding the local return, the local currency return, and the exchange rate, the impact of the exchange rate, or the foreign exchange return, together, subtract the 1, and you get 0.35 for the bullet and 0.29 for the barbell. So the bullet's done a bit better than the barbell. And I think the second part of this question is kind of asking why. What's the reason for that? The bullet outperforms the barbell by 6 basis points. All right, we can see that. This primarily comes from the higher expected roll down return. We've noted these differences. It primarily comes from here, doesn't it? That's the roll down return being higher. There's a slight underperformance here due to convexity. So actually, that's not the major. That's not the major difference. Having noted there'll be difference in convexity, it's primarily coming from the higher expected roll down. And you could point out that the bullet is at a greater discount, so it's going to, prices are going to rise faster as it gets pulled to par. Don't forget, zero coupon instruments are at a discount for when you've got positive rates. They're at a discount and they get pulled up to par over time. So that's the main reason for the outperformance of the bullet versus the barbell. Okay, that completes module 4 of the yield curve strategies reading in fixed income.